Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a company valuation expert in St. Louis, Missouri. I have the privilege of discussing venture capital and startup company valuations today with Lorenzo Carver, a valuation expert in Boulder, Colorado. How are you? Welcome, Lorenzo.
Hi, Melissa. How are you? Good to see you again.
Good. Yeah. So you actually wrote a book called Venture Capital Valuation and have recently co-founded a company, brainsprays.com, which is an educational tool for children using Alexa. So why don't you give us some of your background and experience as an entrepreneur and starting various businesses, because that's really the framework with which you know also how to do valuations, but it's what you've been doing your entire
Right.
career, right?
That's true. Yes. My background for starting businesses, the first business I started was actually a construction company, which is a really, really hard business, by the way. And I didn't know anything about accounting or finance, but we had to get something called a performance bond in order to bid for contracts. So in order to do that, you had to have financial statements, which I literally did not know what it even was. But I did know computers. So I bought a software product and spit out a bunch of financial statements that I'm sure were totally like bogus, but we got the bond and that was it. So,
Right.
so that's kind of how I got into, starting businesses.
And you've created software, you've created financial analysis tools, like all of these types of things that have actually helped valuators do their work, essentially. Okay, so now we get into startup land. And some people don't really understand, like we'll call it emerging markets, or we'll call it, seed companies or early stage. But basically, what is a startup business from a valuation perspective or from, a business perspective?
That's a really great question. So, because the term has kind of come to mean very different things in recent years. So, there's a company called Y Combinator. Have you heard of them? So anybody that's dealing with startups at all should check out Y Combinator. So, a gentleman named Paul Graham founded it and kind of like codified a lot of the stuff that relates to the startup world to kind of gather like a critical mass of people starting these businesses and put them in touch with people that have expertise. So when they refer to a startup, them or Techstars or any of these other incubators and the investors that put money into them, they're talking about rocket ships. So they're not talking about like, oh, let's go start a pizza shop,
Right.
or like, oh, let's go start a construction. They're talking about this could be the next General Motors, which would have been a big thing like 10 years ago, I guess. But
Right.
now, like the next General Motors, that's like a fraction of Google's market cap, right? So,
Right.
but
The next Amazon, maybe.
exactly.
Right?
So that's what they're looking for. They're looking for some stratospheric result. And so the only way that happens is something grows like rapidly, you know? So, and that defines in a lot of ways what a startup is, something that has that ability to grow super fast. And anything that can grow that fast, obviously, you're changing somebody's life, either a business's life or an individual's life, with a product or a service or some kind of angle on the world. So I'd say that that's a definition of a startup from kind of the high growth perspective. But other people use the term a little differently, right? So some people would say, oh, I'm a startup. I just started. So, and I think both are applicable, but I think here today we're really talking about like the high growth version of a startup. So, which, definitively is something that has the capacity, to take over an industry, change an industry.
Yeah, a lot of times I think that people are looking at startups as like, I have an idea and I think someday I'm going to put together a business around it or systems or something.
Right.
And we're really talking about something that has the capability to, with some funding, maybe get to a different place. And so a lot of times people are trying to understand. So I have a good concept. Maybe I have some investors, or maybe I just have smart people that have come together. And then I got to go to the venture, like that's what we always go to just in our minds.
Mhm.
You know, we know angel investors, or we know, smaller investors, family and friends and things like
Mhm.
that. But
Right.
what are some of the different stages of venture capital funding from a startup company perspective?
Yeah, if we're talking about like the real growth companies, that over the last 20 years has almost again become like codified where, it wasn't that way 30 years ago. It just
Hmm.
wasn't. So, all the people, startups, even the VCs, they were investing in things that weren't necessarily like technology. I mean, because I can remember some VC firms that like, oh, somebody has a new toothbrush. Yes, that's technology. Yes, you have a patent on it. But by today's standards, it's like that person would be going to an angel investor or something,
Hmm.
right? Or some family office or something, someone other than like a kind of VC today. But today, the you could say that the stages are pre-seed, which is like, oh, I have an idea of something I might do, and believe it or not, there's whole systems out there to support those people now.
Hmm.
And most of these accelerators, they love people at that stage. And that kind of speaks to another aspect of startup companies and kind of like who can actually get funding. Because a lot of times people that are at that pre-seed stage, they're young people who haven't really maybe done anything else, from a business perspective, but they have some other attributes that make them, kind of suitable to kind of that collection of people. Either
Hmm.
they worked at a successful startup company, they went to a very prestigious school, they have some other like academic or scientific achievement, they crack some code somewhere. You don't
Right.
know, or they just seem like, they're really bright and really ambitious. So you just don't know. But I'm just saying that at the pre-seed stage, there's actually resources for those people today. There wasn't. I mean, there really wasn't 10 years ago, or more
Well,
like 15 years ago.
and these are the
So,
incubators,
right.
right?
Mhm.
That
Yeah.
really try, and a lot of times you actually have to apply to be a part of them. Like
Oh,
you
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 definitely
go
do.
through a
Mhm.
process. Like you don't just say, "Hey, I have an idea. Give me
That's
some
right.
seed
Uh-huh.
funding." It's like you kind of go through an application process depending
Mhm.
upon the incubator to hone your skills,
Right.
hone the concept,
Mhm.
and then kind of where do they go from there?
Yeah, so I mean the incubators, so it's kind of funny. Before I met like NACVA or
Hmm.
NACVA, I actually met them through an incubator indirectly, believe it or not.
Okay.
So when I started Liquid Scenarios, which was to value, venture funded companies, high growth companies, and it would basically suck in like a spreadsheet that just had like their cap table, and then it generate all these models for them and say, okay, this is the value of this company for financial reporting or for tax purposes. And so the a couple of the people on my team were in St. Petersburg, which is like a lot of bright people there. So and they saw that there was a meeting below my office that this VC was having. They're like, hey, you should go to this meeting. And so I went there. I met a really cool guy that was a VC. His partner founded a company called Techstars. So, which is probably like the number two, well, number one or number two in terms of total number of companies that they've funded.
Wow.
And then the other person who founded Techstars is now the governor of Colorado. So, and he actually in his dorm room started like several, like multiple, what became like billion-dollar companies. So, um, yeah, so basically, one of the groups from their first cohort or the first people that went through there, one of the advisors said, "Hey, you should talk to these guys that are doing this triple bottom line tool." And so they visited me. I gave them like, we exchanged some information. They're like, hey, you should check out these exit planning people. And so I went to their event for the exit planning and I met Brian Jones there. So
There you
that,
go. Okay.
so anyway, but yeah, so the seed stage places today, they were writing checks at like 100,000. I mean,
Mhm.
back in the day, I think they were given like 10,000 or something,
10,
or nothing,
25,
like,
50. Yeah.
but they would have these events where all the people in the audience had the inclination and the capacity to write a check, which meant that a seed round, right? So they're pre-seed before they go there, but they're seed once they're done.
Gotcha.
So at the seed stage, you're talking like $500,000 to $1 million today. Back then, you were talking like $100,000, and maybe a bigger seed would be like 500,000.
Mm-hmm.
So, but today, pretty much, if you go through one of those, you're guaranteed, because people know that like they've de-risked this thing, they've honed the message in terms of like what is the startup doing, which that may sound like an insignificant thing, but I can assure you, in a lot of cases, it's more important than what they're actually building.
Yeah. Because I
It
don't
is.
remember, but these events, and I don't remember always like what they're totally termed, but you have a certain amount of time, right? You might have like a minute or 3 minutes to do your pitch, right?
Right.
So you do like your deal pitch and you say, this is who I am. This is how much money I need. Who knows? But it's like a better elevator speech, maybe.
Yeah,
kind of
it
thing.
is. It's like a lot of them call it demo day.
Yeah.
And so, but they used to call it like, just a pitch. And it still is a pitch. And some people say like a 2-sentence description or 1-sentence description of the company. So, and those same guys from Russia actually live here now that I was mentioning. They started a company that I indirectly funded, because they're like, hey, we're doing this thing, do you want to put some money into it? And I'm like, I don't want to take a piece of your company. I said, but I do need some work done. So how much is it going to cost you to do it? And it wasn't that much money.
Yeah.
And so I said, fine, then just, bill me ahead of time and that'll cover your cost, So they want a competition and ended up coming here to the United States and got the pitch like at the first like TechCrunch, like back when TechCrunch was like a startup itself.
Right.
And so, and now they live here and like, in not California, they live in Texas, and they have a very, successful startup. But, but yeah, so this whole pitch thing is like, it's a big deal. And if there's something that's like valuation people can learn from all startups, like communication is such a big deal. And understanding how to best describe a company enhances its value tremendously. So, and there's a company out there that kind of has turned this into a business for like pre-seed or even pre-seed companies. So where it's like, we don't even have an idea, but we built this thing. What do you think of it?
Right.
Believe it or not, now you have like a place for that. So
yeah. Like, do you want to build the idea instead of me? Like, do you want to take it, or do you want me to do it?
Well, it's kind of like, yeah, like we built this thing. Is this a business or not? But whatever, let's have a discussion around it and then see what other people think of it. So, and this company called Pioneer, Pioneer.app, was started by a young guy he's not young anymore, but like when he came here, he went through Y Combinator, and he started a company that he sold to Apple for like tens of millions of dollars. And then he became a partner with a Y Combinator, and now he started this thing, which is for like people with an idea,
Gotcha.
or before they even have an idea. It's like, oh, we coded this thing because, and so, so really it's like reaching back, even further before seed, pre-seed, and now, we don't even have an idea, and let's see if someone's interested.
Well, and I think a lot of people get their knowledge about venture capital or startup funds from like shows like Shark Tank, right? And so, but one of the things that Shark Tank will show you is that there have been good ideas and bad presenters, or bad, not bad, but they weren't the right person to run the company.
Right.
And it became very apparent in their communication that they were not probably going to be the best person. So somebody could buy the idea. So you go pre-seed, you go seed, and then like, what if you get some funding? Now what stage are you in?
At seed, you're either bootstrapping the seed, and you get to select either, some indication of validation. So, and validation can come in a couple different ways. So the best kind of validation is customer. You have a customer that likes your product. You have more than a couple of them. They're sticking around. They're telling their friends about the company. So, and a lot of people in the business will call that traction. So, And if you have that traction, then you have the ability to attract either a seed stage investor, or if you have enough traction and there's enough visibility, then maybe a Series A investor. So a Series A investor today is writing like a $3 to $5 million check. So a Series A investor 10 years ago was writing $1 million, maybe 12 years ago. And so every year it keeps going higher and higher. And some of that has to do with competition, I believe, because there's so many deals out there now. And there's this asset class is like everybody wants it. Like, if you're a pension fund or something like that, or a really, wealthy family or something, they know that venture returns are like what can make a real big difference for them. So, the world is awash in money still. So, but yeah, so the Series A, would come like after the seed. So, and then you have like a Series A investor. Now, some people will still refer to those people as seed investors, but technically, a lot of people will differentiate it. So, and now at that kind of seed stage, in addition to the individuals that would write checks, they have these syndicates. So, and these things have formalized also. Again, didn't exist, I would say 15 years ago.
Sure.
Did not really exist, these syndicates. But they bring efficiency to the process because, all of those people, they're just there to invest at that stage.
Right.
So this reduces a lot of the steps, and also can create a filter to say, okay, we don't want to look at any companies that, aren't connected to these people or aren't connected to these industries. And then instead of one person writing a $500,000 check, you end up with like, maybe 10 people writing a $50,000 check, or
Right.
20 people writing a $25,000 check, or somebody famous that everybody knows saying, here's 10 grand. And because that person did it, it's like the rest of the money just flows in all of a sudden.
Mhm.
So there's places like AngelList. Have you heard of them? AngelList? AngelList. So they've done a lot of innovative stuff with that company. But now they have like a pretty sizable syndicate. I mean, actually probably the biggest one now that I think of it. There's someone named Jason Galakinis. He has something called Launch. You've seen him? Yeah. So, and he's like extraordinarily successful.
Right.
Seed stage investor, invested in Uber, all these companies that became what they call unicorns. So are companies, private companies valued at $1 billion. So, and now he has a syndicate. And there's other people that have started to create kind of unique takes on the venture fund itself, to like eliminate the formal structure of here's some limited partners, and instead like kind of crowdsource these things, so to speak.
Well, because the venture capitalists, like, before would have like a platform company, and then they would want to add more smaller companies that were maybe in that same space or could support it. But with technology changing so much, and these, we're really having the online perspective allows us to know more about smaller companies faster, in my opinion.
No,
you
you're
could have
definitely
somebody
right.
that blows up on Instagram or TikTok, and you couldn't even, that wasn't even a concept 5-10 years ago. So I think that it's kind of disrupting that space, because you have a lot of people that have the money and they want to invest, and they want to kind of find that, potential unicorn, but they want to try to find something fabulous. And it's easier to access that information now, because as long as you're online, like if you're still waiting for some of, the people to find you, that might not work so well. But, we have them online, which I think is a little bit different process.
Definitely. There's no doubt about that. So, and I just say like, private equity versus venture are totally two different things. So like the private equity companies will do like these roll-ups, and, that's more financial engineering stuff. The VC side, I would say, until you get to like the later stage growth kind of funds, there's really no financial engineering there. I mean, so they're purely, I'd say in most cases, other than the people, obviously they're making sure there's a fit with the team. That's like the number one thing, that they believe that those people can take it all the way. The other piece is just the market. So, where they say this is a market that is ripe for someone to change it. And it's going to be big enough that if we get our little sliver of it, we have a magnificent return on, investment. So, yeah, but you're right. I mean, definitely everything is easier in a lot of ways because one, distribution's easier. So, because now like you make something and it goes out immediately. The flip side of that is competition is greater. So when I wrote my first software product, there were literally only, I think, 100,000 software titles in the whole world. That's in every language.
Right, right.
So as long as it did something, I would get some customers.
Right.
Today there's probably 100,000 new products every week.
Right.
So then just think of like an iPhone, right? Where everybody's making an app for the iPhone. And so to get someone's attention and say, one, this is something that you need, it's a lot higher bar to do that. And so the marketing piece becomes in some ways more difficult, but awareness or your kind of distribution channels are substantially, more accessible because all you have to do is, get through certification from Apple or Google or Amazon. And all of a sudden you have access to billions of users around the world, right? So whereas before, when I started, I made a deal with a company called Digital River for my first product. And they just started, the internet had just started in terms of being a way to distribute software. So I had to print like a bunch of CDs. And I remember thinking to myself, one, this is a lot of money to print these CDs. Two, if there's a bug, you're like kind of screwed,
Yeah.
Because now you printed all of this stuff, you can't update it. And I literally had, I would say like mini nightmares, like after it was released, like that there was some bug in there,
Yeah.
Fortunately, there wasn't, because with finance stuff, if there's like a number that's screwed up or something, it's pretty much a brick,
Yeah.
I was going to use it. So
yeah, no, I think things have completely changed, but you have a good point that most early stage companies are probably looking more at the private equity space, or private equity players are looking at them. Venture capital is going to be kind of in a different, you're going to look at that much later in the stages, right?
I would kind of flip those.
Flip
so
them.
the
Okay.
private equity people are looking for, they're like closer to the financial buyer, even though they may be strategic, right? But they're really the financial buyer in the valuation context. So
Right.
where it's like, okay, if I can buy in all these companies, then, I can eliminate these things and get this higher multiple. And if I buy them on the cheap, then, I package the whole thing. I can sell them either to another platform or I can take them public. So that to me is just like financial engineering. VCs don't care about that. I mean, they really don't. They're not even thinking about that. They're not thinking about selling to private equity, although sometimes you see those transactions, especially today at the growth level. They're literally thinking, okay, here's a team, at the earlier stages, that has the capability to disrupt the market and get a big chunk and have some advantage over time. And so there's nothing to show for it. I mean, really, So it's other than like, kind of an indication, a signal that there's potential, but a lot of that signal is from the person that they're talking to and from, kind of their gut feel and kind of experience. Then they look for validation, honestly, which the validation, like I said, is either they impress somebody else that they trust. And frankly, that herd mentality, that's a big part of it. And the other piece would be, that they've actually convinced customers. And one of the reasons that's so significant is because, amongst other things, I'm sure a lot of them have backed companies, and put large amounts of money in and had no customer traction at all, where it's like, all right, we put this money in and nobody wants this thing.
Right.
And so, a lot of people have done a lot of iterating around that. And so, there's kind of systems in place for people to get a feel of whether or not there's really a potential need for this in the marketplace. And if this is the company to address that and kind of get that fit. And like a term that they all use is like, kind of product market fit, which
proof of concept.
Yeah,
Yeah.
exactly. So,
Do people even want this
right.
product?
Uh-huh.
Yeah.
Yeah.
But what I was thinking is that when they're looking for funding or when
Mhm.
they're trying to get funding, people talk about getting, try to get some capital, or they talk about try to get smart money.
Right.
And so everybody's kind of between, do you just need the money because you have the
Mhm.
systems in place and you have the management team, or
Mhm.
do you need to get smart money? Should you just ever always get smart money or
No.
no?
I mean, it depends on what you're doing.
Yeah.
So, and it depends on who you are. So,
Hmm.
and I can give you like pristine examples of companies that
Okay.
would never ever get venture capital.
Okay.
Seriously. They just never
Gotcha.
would
Yeah.
because of, who they were, what they'd done in the past, but somehow, they hacked the system and they achieved tremendous growth, better
Hmm.
than like whole portfolios of venture backed companies. And in those instances, they would never get professional money from a VC.
Hmm.
However, after they get rid of that company, now they can get professional money from anybody. And,
Hmm.
there's companies that I know that like people that have started companies where they got $250,000 from friends, family, whatever, and generated $100 million in cash flow. In
Hmm.
cash flow, not selling the business, actual cash flow,
I
and
love it. No, just kidding.
you don't really see this from venture back companies. I'm just being honest, you
Yeah.
don't. I mean, that's like the exception to the rule, but that's not their model. That's not what they're trying to do. They're
Yeah.
trying to get the top line growth. They're trying to get the customer growth, and they're trying to basically push other people out and say, this is a new way of doing this. And the example I gave, they were in like, you know, financial services industry. And basically, so this is like a mature industry. Yes, they were incredible managers, and they were applying technology, but it wasn't proprietary technology. It was
Hmm.
basically they just knew what they were doing and they did it better than anybody else and they made a ton of money. And there's lots of examples of that.
Hmm.
Um, but those companies, they're not a fit for venture capital. Now, once they get up to like 50 million, yeah, there's like tons of people that will like fight over one another to like put money into the thing. And a
Hmm.
lot of times they really don't need it at that stage. They can go to the bank and get it for nothing. So
Hmm.
if they need working capital. So
Well, and I think that that's the hard part in the startup land, in the incubators. Everybody wants like the right answer. Like, tell me the answer of how I'm going to get the money and make millions of dollars. And there isn't always a right answer. And then
mhm,
the next thing that they kind of go through is like, okay, well, then I need a formal valuation
mhm,
and I need to know what I'm worth. And,
right.
I haven't really started anything. So, I mean, let's be real. Like, do you need a formal
No.
valuation if you're seeking
Waste of
funding?
money, waste of time. So complete waste of time. First of
Yeah.
all, the least the least qualified people to tell you the value of an early stage company is a person doing a valuation. I mean, just being honest, and I
Mhm.
would definitely include myself, and I've like looked at thousands of these things. So, and there's just you have to have very close domain expertise. And so, in my opinion, in a lot of cases, the person that's actually writing the check, if they're writing a lot of those checks, they have a feel for what it's worth. And
Mm.
they have that feel only because they put that on the line several times. They've talked to the people, they've seen the industry. So the person writing the checks, 9 times out of 10, they have the best perspective. Doesn't mean they have the best model. When it gets to later stage, they definitely don't. But that
Mhm.
doesn't matter, because most deals will not even get to later stage. Then beyond that, there's people that just have really extraordinary domain expertise. So one person is this guy, Robert Scoble, who's like been around tech companies. He's written like several books. He's like, had a camera shop. I mean, like all this stuff, but like he could tell you like the value of Tesla, like before Tesla was Tesla. He could tell you the value of Twitter before Twitter, like half the people in the world even knew what it was.
Mhm.
So no valuator could do that, just
Mhm.
honestly. I mean, in fact, one of the best valuators for these types of companies, I remember him at a conference once, like making jokes about people with Teslas. And I thought to myself, you obviously have not been in a Tesla. this was, I don't know, maybe like, I'm going to say a decade ago or something, right? So, because if you had, you'd realize like, it's like going to make these other cars dinosaurs,
Yep.
and all these companies are going to have to catch up.
Yeah.
So, and so it's similar, but like if you go further back in time, a lot of these things are like, not, there's not these layers of abstraction available. Like
Mm-hmm.
if you go back to Cisco, like how many people actually even know what like networking was or what a router was? Nobody had like internet when they started, other than like the military, right?
Mm-hmm.
So there's like a smaller pool of people that can even understand what the value proposition is. If you go
Mm-hmm.
further back in time, go to Intel, right? When Intel was founded, I mean, you maybe had, if you had 1 million people in the United States that even knew what a freaking semiconductor was, I would be shocked. You know,
But
so
that's the hard answer that I don't think people really want to hear all the time, is that the best person to kind of value what you're worth at that level is
mhm,
somebody that's willing to put their
that's
money
right,
into it.
exactly.
And you might have to go through a bunch of different of those types of people that have different ways of looking at the value,
Hmm.
that call it valuation,
Right.
just like we do, but
Hmm.
it's really private equity looks at it different, venture
Hmm.
capital looks
Yep.
at
Definitely.
valuation different, and
Mhm.
then within those two, every single firm looks at
That's
it
right.
different.
Exactly.
But I don't think that the startup community understands that. They kind of think, well, you're just saying that because of whatever reason. But
Hmm.
the reality is, I said your company is worth what somebody is willing to give to
That's right.
you for a certain percentage,
Hmm.
and you are willing to accept.
That's right.
Because on a given day, if you need the money, you might
Hmm.
accept less than you would on the next day.
You
And I
got it.
think that that's
Hmm.
hard to grasp sometimes because they think that there's some number out there, like that we're going and we're finding that number and then we're
Hmm.
bringing it to them as a package and saying,
Right.
guess what? You're worth 5 million or you're worth
Hmm.
1 million, and I think that that's a hard thing to understand.
It
So,
definitely is. And I mean, the other piece is, even once that person is giving you the money, and this is where a little bit of background or maybe evaluator that has experience in the space is kind of helpful, is even if they said, okay, here's 30, I'm taking 30% of your company and I'm giving you $1 million or something. The reality is they're getting preferred stock,
mhm,
so that is worth a whole world of things different than the common stock. At the earliest stages, yes, management still has, like, in theory, some control, but most of these things need another round of funding. And
mhm,
the person that's generally going to get that is like the other investors that are involved in the company. Obviously, management has to execute, the founders have to execute. So it's not just a percentage that they're getting. It's really like, what are the terms?
mhm,
So like sometimes, they have like a preference, like they get paid first. And there's countless stories, not so much anymore, but like years ago when the terms were a little more, let's say, not founder friendly. And some were truly draconian, especially on the East Coast, and
mm,
especially in like the biotech space. But there's reasons for that, because when we say startup, we're talking like broadly now, but there are clearly differences. Like if I'm talking about a drug company, an early stage drug company, versus I'm talking about, you know, here's a social media company, or
mm,
here's something like some kids can literally like hack on the weekend and they have a product on Monday. And then if somebody puts a little money into it, then maybe they have 100,000 customers in a month, you know?
mm,
Whereas if you're talking about a drug, something you're going to stick in somebody's body, yeah,
mm,
that's regulated in this country.
mhm,
So there's this whole, it's going to take you years and
mhm,
a ton of money to get to the stage where you can even put that into a person, a human, unless it's, some kind of special case like orphan drug or something like that. And
mhm,
so because of that, then you have a totally different set of investors and they have a different set of expectations, even though they're both venture capitalists. And historically, you've had a complete different set of terms. So where you look at a lot of these companies, they have something called a cumulative dividend, where it like accrues this dividend, effectively giving them a bigger chunk of the company over time. You know,
mhm,
Well, that may seem like really unfair if you're talking about an internet company. But if you're talking about a drug company, it's like, yeah, we don't know what's going to happen.
Mhm.
So the faster you meet your milestones, you know, the less this accrues.
Mhm.
So not unreasonable, you know?
Right.
But yeah, so it's not just the percentage that they get, which that's the other thing. Like in a lot of people that are beyond the stage of, is this company going to get funded? And they're actually negotiating with VCs. Um, I think a lot of people get hung up on like what's the valuation that they're getting. And I'm like, you know, I understand they have to do that because, that's a good person. They're like negotiating. But I'm like, you're negotiating the wrong thing because the thing that matters is you're going to be with that person for a long time. If that person sucks, or if there's like any question about whether or not you can trust that person, you need to shop around. It doesn't matter what the number is or what the deal terms or who they know is, because it'll come back. And
Mm.
I mean, I've met like lots of people that have built multi-billion-dollar companies, and that sounds kind of funny. It's like, you met lots of people that, yeah, I have. And I'm always shocked at how many of them hate their investors. I mean, like literally, oh, I hate those and VCs. And I'm like, this is very interesting because I'm like, well, there's that, but without that capital, but like from the founder's perspective, a lot of times they're like, I could have made this so much bigger.
Yeah.
And I mean, that seems shocking to like, if you've never done that, but there's great examples of people doing that. So one would be like PeopleSoft. You heard of them?
Mhm.
So they got acquired by Oracle, who like, they bought so much stuff and now it looks like maybe a piece of TikTok, but, but leading up to that point, I mean, they actually institutionalized this thing of like acquiring tech companies, like
Mhm.
when nobody else was doing it.
Mhm.
And so when they bought PeopleSoft, the founders of PeopleSoft were not really cool with that, you know? And even though that was like a massive acquisition, and
Mhm.
they went out, they started a new company and it's huge. I mean,
Mm.
it's massive, just as big. So yeah, when they're like, you know, we're better than that, a lot of
Mhm.
times they're right, you know?
Right.
But like the
Well,
VCs, they need
yeah.
their money back. You know, they have investors, you
And
know?
the trade-off is that you need money as a
Mhm.
startup,
Right.
and they'll give you money, but they're
Mhm.
gonna take, and maybe they only take 10, 15,
Right.
30%, but they're going to be equal control or more
Right.
control. And
Exactly.
that's where it
Mhm.
becomes, it's no
Right.
longer kind of a dictatorship, it's a democracy. And now we
Exactly.
gotta vote on things, and
You
now we
got it.
gotta agree to
Mhm.
things.
Right.
And so I think that that's really a good thing, that if you're gonna start taking money from people, you have to be kind of aligned either in vision, in
Mhm.
personality. Like, I
Definitely.
like to say, well, I like to say this more so for when you're like partnering with somebody, but in general, but like if you were stuck in a basement with them for like a week,
Mhm.
are you both coming out alive? Because if you're not,
Right.
that's not the person, because some of these are difficult conversations. Growing a company is
Mhm.
stressful and painful.
Yep.
And so you want somebody that maybe you don't want to kill in the basement, but no, we'd
No,
never do
that's totally true. I mean, seriously. I
that.
mean,
Right.
it's a marriage, you know?
Yeah.
And like there's more than one investor in a lot of these, all
Mm.
these companies there is. So, so now you're married to like all these other people. Now, obviously, usually there's like one person controlling the shots at each stage, but it's
Mhm.
kind of funny because yeah, I mean, you're in bed with all of these people.
And some
And
are quiet. Some just want to like, here,
that's
take the
right. Mhm.
$5,000. I just want to be a passive investor. And then they might say that, but then
Mhm.
they're not just sitting back and doing nothing.
Right.
But there are a couple times when we need an actual valuation.
Mhm.
And so can you tell us a little bit more about like what is a 409A valuation, which I
Yeah,
think
definitely.
most startup people know that
Mhm.
term,
Right.
but like when do they actually need it is the
They
question.
Yeah, they need it when they start issuing stock, after they got financing typically.
Okay.
So historically what happens now is when you issue founder stock, a lot of times it's valued at par value, which is effectively saying it's worth nothing,
Right.
which
A
is
dollar.
not unreasonable, you know? So whatever the par value could be 0.001 per share. So yeah, it ends up being like a dollar, $100 or something. that's not significant to anybody.
Mm-hmm.
Back, I think it was, I'm going to say around 2005-ish, 2006. There was this weird thing they did with the tax law where they thought they were like going to somehow recover money from people's stock options or something. And they came up with 409A. So to basically do that,
Mm-hmm.
which is ridiculous. It's more applicable to larger companies, frankly, where
Okay.
they were doing like some crazy stuff with stock options. I mean, when I say crazy, I don't want to say illegal because I'm not a lawyer, but it seemed illegal. I mean, to me, you backdate, you're publicly traded, you backdate your options. I mean, you
Right.
deal in litigation. I mean,
Right.
but
Doesn't seem like a great idea.
no,
Right.
but like with the right lawyer, they all got away with it, So there's a lot of it going on.
And a
So,
lot of it was they created this 409A valuation process, I guess, because you would also want to get people involved and you would instead of because you didn't have any money to pay them, right?
mhm,
And so, but you needed a CFO or you needed a CEO, and you'd be like, hey, why don't I give you some stock
right.
in exchange for that's your compensation kind of thing.
And they had standards for that. That went
Mm-hmm.
on for years. And
Mm-hmm.
frankly, going back to the Intel example, I mean, this was a lot of the reasons why tech companies were able to attract engineers that otherwise would be working for large companies
Mm-hmm.
because those large companies were given any stock to employees. The only people getting stock were at the C level. So executives that typically weren't from a technical background, largely from a managerial background. So
Mm-hmm.
basically, they were basically like kind of dictators. And so
Mm-hmm.
like the people actually like cranking this stuff out were not getting a piece of the pie. And
Mm-hmm.
so it was a great tool for people to attract that talent to say, hey, you're going to have a piece of the company. Even though statistically, most of those companies, they're never going to survive. But some of
Mm-hmm.
them, it's going to be like a windfall of windfalls and pay for great grandchildren to live, go to really good schools, drive nice cars, and whatever.
Mm-hmm.
So, but what they used to do is a lot of times they would just say 10% of the pricing for the preferred, and historically that's what you saw a lot of. And then some people would change it. They would be like, okay, it's 10% at this stage, then later stage is maybe 30%, 25%, but typically it used to be like 10. You'd always see 10%. And if you
Mm-hmm.
go back to old filings and look at them, you do the math, it's usually 10%.
Mm-hmm.
So that's what it was. So the other thing that coincided with the tax law changes was what was called at the time FAS 123 or FAS 123R. You may have heard of it.
Mm-hmm.
So, but basically it was saying, and this goes back to like this whole concept of, oh, we got more companies that are public now where all these employees have stock options
Mm-hmm.
and there's no expense. So aren't you giving up some value by
Right.
giving them these shares? Shouldn't that be reflected on the income statement?
Right.
I'm not arguing either way, frankly. I mean, I think financial accounting is such a mess now. Like, seriously, nobody read the freaking financial statements 20 years ago.
Right.
Now
Right.
they're like 10 times as long.
Mm-hmm.
The actual bankers on the deals do not read them.
Mm-hmm.
You know, the analysts don't even read the whole financials. I mean, it's that big that no one, it's not approachable.
Mm-hmm.
So, but they've added all this fair value stuff, so it's there. But the objective was to get a more kind of fair way of presenting it, because
Mm-hmm.
yes, you gave something up, right? And what you gave up would not be reflected in the financial statements until you're generating positive earnings. Now, some of that is like kind of a catch-22 because the only reason it's like that is because the accounting rules,
Mm-hmm.
which said we don't include those shares, right?
Mm-hmm.
Because if you include those shares, then all of a sudden earnings per share actually doesn't go down by as much, you
Right.
know?
Right.
So so they basically applied really some primitive options pricing methodology, and said, okay, we want you to capture this cost, and they did it kind of incrementally. But when they went like kind of full throttle on it, it's right around the time that the 409A stuff happened.
Mm-hmm.
So, and because of that, then the auditors are like, well, we got this one thing to deal with, we got this other thing to deal with. Hey, let's just put those two together and say,
Right.
and and like mash it up. And so
Because that's really what people think they need in all
Mhm.
capacities, but they don't. I think
Right.
just working with somebody that has a basis of understanding of how to do projections,
Right.
how to do your cap table, how
Mhm.
to figure out, okay, now you have all these rounds of investments
Right.
and investors, like what is your portion still
Uh-huh.
worth?
Yeah.
But a lot of times when I go into these incubators and talk about valuation, they'll ask me, they're like, well, can you really value a business with no revenue?
Absolutely.
Like,
You
so tell us.
definitely can.
Yeah.
So, I mean, so, whenever they talk about like the purpose of the valuation, it's not
Mm-hmm.
a joke. It's a real thing. It's like, so like, what is the purpose? Okay, the purpose is here's a number for the IRS.
Mm-hmm.
Here's a number for the auditor. Here's a number the auditor will live with.
Mm-hmm.
Now, unfortunately, that gets into the blurry area in my mind,
Mm-hmm.
where if someone is a professional evaluator and they're just doing what the auditor tells them to do, that to me is a little
Mm-hmm.
twisted.
Mm-hmm.
Because first of all, they're supposed to be independent. The evaluator is supposed to be independent, and they're clearly not. Because if they were, then there would
Right.
be a
Right.
lot less kind of working together. And okay, we'll change it. And literally, they would tell people like from big four firms, just change it.
Yeah.
I'm like, no.
Because
So,
it is, I
huh?
mean, essentially the 409A valuations or even valuing a company with no revenue is
Hmm.
an option pricing model with
Yeah,
assumptions.
it
And
definitely is.
you could have different assumptions than I
Right.
could have,
That's
and
right.
they could all be in a reasonable range.
Yeah.
But they have different outputs that we say, okay, now it's worth
Mhm.
5 million, now it's worth 1 million.
That's right.
And that's the
Mhm.
difficulty.
Yeah, and the other thing is if you look at what is someone trying to achieve from a return standpoint. So if
Mhm.
you're talking about like, oh, I want a 14% return, that may seem a little rich for like you're going to do this every year with a publicly traded company, that's of some size. But if you're saying I'm going to do this every year with a venture backed company, that's a loser
Mhm.
because the volatility is so high that if that's all you're getting, then you're getting a negative return because the next year you're like underwater, you
Mhm.
know?
Mhm.
So when something's that volatile, then we don't expect a grouping of indications of value, you know?
Mm.
So people force that to happen.
Mhm.
So, and it's usually based on like, just available information,
Mm.
experience, who you're
Mm.
dealing with. And, so the number is always going to be wrong. That's just the way it works.
Mhm.
I mean, it just is. And so, yeah. So, I mean, but pre-revenue companies, they get valued all the time. They get valued when somebody puts money into them.
Right.
And all these systems, everybody's using that as an input. So
Mhm.
that's a primary input. They take that, they put that into typically an option pricing model. And then there's alternative models that the AICPA accepted. None of these models, by the way, were ever being used by the people that were the primary investors.
Mhm.
And I think that
That's the
doesn't
huge
just indict
disconnect.
all of them, but it does raise the question, you know?
It definitely is, I think, a huge disconnect kind of in
Hmm.
reality of what happens when companies are funded.
Right.
And, and literally you can talk to, and a lot of these startup companies do, they go listen to, a VC talk about this, and then they listen to another guy, and they always ask, well, how do you value it? How do
Hmm.
you figure it out? And a lot of the hard part for the VCs are like, well, because I see a lot of these,
Hmm.
because I've decided how much, I mean, because sometimes it's passion. A
Hmm.
lot of times you need to find somebody that has at least some passion about whatever you're creating
Hmm.
so that they are more interested.
Right.
Sometimes you just have to find that they have extra cash laying around and they're willing to give it to you. So, I mean, there's just so many answers here.
Hmm.
Um, But I do want to talk about something that I think is very interesting, that is kind of your new project called
Right.
brainsprays.com.
Mhm.
And this is fascinating to me because I have, children that are being homeschooled right now, and I have a 5-year-old that probably needs to get her act together. So tell us more about this concept and kind of how you created it.
Yeah, definitely. So brain sprays are interactive Alexis lessons that teach 2 to 5 year olds how to read and multiply like 7 to 10 year olds. So, and so the inspiration for me was actually my daughter, and so we'd done various techniques, like when I would drive her to daycare, um, different things to teach her how to read, and teach her how to spell words, teach her how to count numbers. And but then when she would go to daycare, then these skills would go backwards, because you're around nobody else, the other kids, and the teachers, they don't even know, because at that age nobody
Mhm,
can tell what they're saying other than their parents anyway.
mhm.
So I started building these Alexa skills to reinforce and also introduce new skills. And so ended up with a collection of these. And so I had a reading at a first grade level by the time she was 3. And obviously, she did, the work. um, and and when COVID started, it was interesting too because she was in a preschool then, and I was really shocked when I saw what they were actually doing there. I'm like, oh my god, was this a really big mistake? Because like you don't really see it when
Yeah.
they're going there,
Mhm. No.
and but then when you actually see like this is what they're doing there, it's like this was like a really good school, and I'm thinking to myself, clearly we have to do better than that.
Mhm.
So at that time, they said that she could add like 2 to numbers or something. So within 3 weeks, she knew half her multiplication tables, and so then started writing some songs for these things, incorporating them into Alexa skills. There's an incentive system for them. So there's about 1,200 kids using it right now.
Wow.
And then I hope to have about 100,000 using it by the end of the year.
Mhm.
And my goal is on the reading to, get 1 million kids reading before they get to kindergarten, and a
Mhm.
million kids doing multiplication before they get to kindergarten. Because if you look at the statistics, right now, kids in Singapore are supposedly 3.5 years ahead of kids in the US in math, and 2.5 years ahead in reading. And we spend more than most countries in terms of, how much
Mhm.
it costs to send a kid to school? It's
Right.
like $66 a day.
Right.
$66 a day. I
Mhm.
mean, that's more than a lot of people's housing costs per person.
Mhm.
And
Yeah.
so, and still we're like way behind. So I don't, even if there was like a system to say, oh, we're going to make this all better, and let's put it in the school system, it would take you 15 years to like train the teachers and get through all the legal stuff.
Right.
So the better thing, at least in my mind, is just to fix it before they go to school.
Yeah.
Because in school, there's tons of distractions. You don't know who they're going to end up with, which is a big factor. And so just teach them that before they get there, and then they can teach themselves.
Yeah.
So if they can read, they can literally teach themselves. And
Mhm.
if they can multiply, then really, and they start that early enough, then there's all sorts of mathematics that open up. So now you can read, now you can do math. So yeah, so
I'm
that's
gonna
what it
test
is.
it out with my kids. I
Hey,
I feel like I
great.
should do the 5-year-old and the 10-year-old
Mhm.
together, right? See who wins. Be like, "So you have a basis of understanding of reading and math, and she has none. Who's gonna get there faster?" Because it would be a fun test, right?
Mhm.
Like, because I think one of them's struggling a little bit, so he might need to go back to the basics. I don't know. We'll see. It's
Well, I've
question.
seen examples where, I mean, it's very interesting because right now, I mean, if you give her like any sight word, so I have actually, I can send you some links. So I used
Yeah.
to randomly just pick up sight words for like, here's a list of sight words that sixth graders should know.
Oh, yeah.
She'll just go through like 85% of them. She'll get them the first time. And so, and And I think that a lot of these things just you have to start sooner. So,
Yeah.
and we didn't spend like all day long or even an hour. Like the multiplication tables literally spent about 15 minutes a day, like introducing a new concept. But if there's some motivation, then the kid will reinforce it themselves. And the other thing is not memorization either. So none of my stuff is memorization.
Yeah.
Which
Well,
I think,
it's fascinating because, of course, during COVID, everybody's had electronics and things like that. And I watched my daughter, and legit, she knew how to work everything, but she was like playing a game. And then all of a sudden, she was like, oh, I really like this. And she did talk to text within the game, text out
right.
to all of her friends that she liked whatever was happening. And I was like, you don't know how to read.
Yeah.
You just texted all your friends in the game, and yet you have no concept of what just happened. But you know how to do all of those things. And I was like, I don't barely know like what game you're playing, you know? So, I mean, I think that kids are very smart, younger. It's just kind of giving them the tools. So I don't know. I'm going to try it. If she's reading by the end of the year, oh my gosh, Lorenzo, that's going to be crazy.
Does she know her phonics? Does she know the sounds that letters make in the alphabet?
Why are you asking me hard questions?
Oh, sorry. Because if she does, I'm just saying she can be reading in 3 months easily.
Oh,
so in 3 months.
We're gonna come back in 3 months and we're gonna see. I love this. I love this concept. Even better than the valuation stuff. I think this is awesome.
Thanks.
But anyway, so do you have anything else that we will put up? This is the
thanks. I appreciate that.
Yeah. So do you have any other tips for maybe startup companies in this process instead of kind of being focused on the valuation, maybe some other areas they should be focused on?
Oh, they should never, ever focus on evaluation. So the only thing they should focus on is the customer. And I mean, and this could go to any company. So if you want to stay in business, or you want to get into a business, or you want to grow a business, your knowledge of the customer is the most powerful thing that you can get. Okay. And so, talk to as many people that you think are your customer, because you don't know if it's a new product who's your customer. You make some assumptions, but they need to talk to as many people as possible that they think are, and actually not people that you know. So talk to the people they're like, oh, that's so cool.
Right. Right.
So, yeah. So,
yeah, because you don't know who could be an investor either.
Right.
Like the more you talk to people, the more you get some concept. But we've also put down your book that you wrote.
Oh, thanks.
So if people want to refer to that, and we will attach all of your contact information to the video and the podcast, so that if they have more questions, they should definitely call you, right?
Funny.
Well, thank you so much, Lorenzo. We appreciate it, and we'll have you back. And because I really need to understand Alexa more anyway. So we're going to have you back for like a technology session. How about that?
Okay, awesome. Sounds good.
That'd be fun. Okay.
All right.
Talk to you soon.
All right. Take care. Bye now.
Bye.